from Lilu's investment in Lukoil, a deep dive into a value play. Part 1. The Asymmetry of Chaos. Buying a dollar for a penny. Alright, here's the one idea that matters. The one idea that explains the entire trade. When the price is absurdly low, you don't need a perfect future. You just need reality to not end. That's the Lukoil story. At the time, Lilu is not some seasoned fund manager. He's in his early 20s. A student. This is pre-Himalaya capital. No outside investors. No leverage. No institutional backing. He's investing small amounts of personal capital money he's saved, recycled, compounded carefully, because that's all he has. That matters. When your capital base is small, you can't afford elegance. You can't afford consensus. You're hunting for asymmetry. He's at Columbia University, and he's already fully switched on to value investing. He famously walks into a Warren Buffett lecture, thinking it's a buffet food, not philosophy, and instead walks out obsessed with margin of safety and intrinsic value. He studies under Bruce Greenwald, the intellectual heir to Benjamin Graham, and absorbs the idea that price, not narrative, is where risk lives. Academically, he's an outlier even there. He becomes the first person at Columbia to graduate with 3 degrees simultaneously. Economics, law, business, all hard degrees. And all while staying in the living room with 8 other people and barely speaking any English, and just about 30 years of age. Not only that, but he used the float from his student loans to make his investments. That background matters because it explains how he can sit comfortably with legal uncertainty, financial chaos, and incomplete information, and still act. Because he's young and capital constrained, he's not looking for great businesses at fair prices. That comes later. Right now, he's looking for the opposite. Obvious, screaming mispricings, cigar butts, situations where price has completely detached from reality. And then the world breaks in a way that perfectly matches his skill set. Soviet Union collapses. An entire command economy disappears almost overnight. Prices are unanchored. Inflation explodes over 2,500% at the peak. Savings vaporize. Wages lag reality by months. People stop planning years ahead and start planning days ahead. After the collapse of the Soviet Union, Russia undertook shock therapy economic reforms, rapidly moving to a free market system. In 1994, the government privatized thousands of state-owned companies via a nationwide voucher program. Every Russian citizen received vouchers that could be exchanged for shares in formerly state-run businesses, including prime assets like oil giant Lukoil and gas monopoly Gazprom. However, the process was so abrupt and unfamiliar that most people didn't understand what the vouchers or shares really meant. Ordinary workers and citizens, grappling with hyperinflation and economic chaos, were happy to swap these paper certificates for immediate cash, something tangible they recognized. As Lilu later recounted, somebody could come along with real cash, and they freely gave away. As a result, these assets were trading at extraordinarily low prices. The macroeconomic backdrop in early 1990s Russia was extremely turbulent. The country experienced hyperinflation, prices rose over 2,500% in 1992, and a collapse of its financial system, leaving many enterprises nearly bankrupt. To local citizens, shares in companies like Lukoil seemed virtually worthless. Owning them was viewed as a burden rather than a benefit, since Soviet-era companies carried heavy social obligations to employees. In contrast, a few contrarian investors, Lilu among them, saw a once-in-a-lifetime opportunity. Russia was one of the world's largest holders of oil and gas reserves, and history had shown that great nations' industries can recover with time. The voucher privatization meant pieces of these resource-rich companies were essentially up for grabs to anyone with the foresight and nerve to participate in the chaotic auctions. This isn't theory, it's survival math. And into that chaos, the Russian government launches voucher privatization. Every citizen receives a voucher paper certificates representing claims on former state assets. Factories, mines, steel plants, and oil companies. Real productive assets. One of the largest ownership transfers in history. On paper, it's revolutionary. In practice, it's chaos. There is no mature stock exchange, no culture of equity ownership, no trust in institutions. Trading happens over the counter, informally, often face-to-face. Physical certificates change hands in street markets or through primitive brokers. To someone living through hyperinflation, A voucher isn't ownership, it's confusion, it's risk. It's something you can convert into food, rent, or vodka today. So people sell, immediately, cheap. This is forced selling, not because the assets are bad, but because the sellers cannot afford patience. That's where the price signal breaks. That's where Li Lu sees the gap. Li Lu's analysis of Lukoil exemplified classic value investing at its best. He realized the stock's market price bore almost no resemblance to the company's underlying worth. How cheap was Lukoil? By Li Lu's own account, forget about earnings, just look at assets. At the time, oil was averaging about $20 a barrel, yet Lukoil's share price implied a valuation of only 10 cents, 20 cents per barrel of oil reserves. In other words, Lukoil's shares were trading for as low as 1 cent on the dollar of asset value, sometimes even half a cent on the dollar in extreme cases. It was ridiculous, Li Lu later said of these prices. This meant investors could buy into one of the world's largest oil companies at a 99% discount to its book value. Such an extraordinary gap between price and intrinsic value was a neon-flashing signal of a high margin of safety investment. Even Gazprom, the gas giant, was available at similar giveaway prices, and Li Lu saw the opportunity during this period. Crucially, the information to recognize this mispricing was available at the time to those who looked. Li Lu and a handful of intrepid investors noted the oil reserves and assets these companies held. Lukoil alone had billions of barrels of reserves, and performed simple arithmetic against the token share prices. The Soviet-era financials may not have been easy to obtain, but basic data on reserves and production was known. By comparing the implied cost per barrel of reserves to prevailing oil prices, Li Lu saw an enormous discrepancy. He also understood the context. Russian citizens were selling because they valued immediate cash amidst economic hardship far more than a distant claim on corporate assets. This informational asymmetry, where locals underestimated the value while informed outsiders saw the bigger picture, created the perfect setup for market inefficiency. Li Lu essentially had insight that the market price was wrong, grounded in both data, asset values, and history. His study of past economic recoveries, for example, post-war Germany and Japan, likely gave him confidence that Russia's companies could eventually normalize. In short, what Li Lu saw in Lukoil was a dollar trading for a penny, due to temporary chaos and ignorance in the market. He doesn't start with a story about Russian reform. He starts with balance sheets and hard assets. Oil is global. Oil is priced in dollars. Oil doesn't care about Russian politics or domestic inflation. A barrel in Siberia is still a barrel on the world market. That's why oil had to be the focal point. Hard assets with global pricing neutralize local chaos. So he looks across Russian oil broadly, Lukoil, Yukois, others, but Lukoil stands out as the cleanest expression, one of the largest integrated oil companies on the planet, formed from major Soviet entities sitting on enormous proven reserves in Western Siberia. And he does not build a sophisticated model. He does arithmetic. What are the proven reserves? What is oil selling for globally? What price is the market assigning to those reserves? The answer is insane. Russian oil reserves are being valued at roughly 10 cents, 20 cents per barrel, sometimes even less, while oil itself trades around $15, $20 per barrel. That's not cheap. That's a dollar for a penny. So the question isn't why buy, it's why is it priced this way? The oil is real. The reserves are real. Soviet reserve data, especially for proven fields, was historically conservative and technically rigorous. The problem isn't the asset. It's the seller. The sellers don't think like owners. They're trading long-duration claims on future wealth for immediate certainty today. This isn't a functioning market. It's a liquidation. Now here's where Li Lu's mindset matters. He sees every risk clearly. Political risk, rule of law risk. Custody risk, do I actually own this? Nationalization risk, corruption risk, currency risk. He assumes almost nothing and trusts nothing on faith. He does the work mapping ownership structures, figuring out how foreigners can buy indirectly through brokers, vouchers, or physical certificates, and navigating ownership caps, registrars, and legal gray zones. And because the risks are real, he demands something extreme in return. A 99% margin of safety. He's saying he doesn't need to understand Russia perfectly, doesn't need reforms to succeed, doesn't need clean governance. He needs the entry price to be so low that even if he's wrong about half the story, there's no permanent loss. That's pure Graham. Buy at 1 cent on the dollar, and the world has to end, or the asset has to be fully confiscated for you to lose permanently. So he acts, not cautiously or experimentally, but as much as his limited personal capital allows, he leans in. He accepts friction physical certificates, OTC chaos, illiquidity, travel, discomfort, because there is no clean brokerage experience here, and that friction is the moat. The harder it is to execute, the fewer competitors remain. The trade doesn't resolve cleanly. Prices swing violently. Volatility is extreme. And then in 1998, Russia defaults, the ruble collapses by roughly 90%, panic returns, and most investors quit. Executing Russian equity trades in the early 1990s wasn't clicking a button. It was a logistical operation in a Wild West system. While he never disclosed the exact broker, the mechanics were clear. Through voucher auctions, investors bought vouchers on the secondary market, often with cash, and tendered them for shares. If few people bid, the shares per voucher ratio was high, driving the effective price down. Before a formal exchange existed, trading happened over the counter, with intermediaries matching buyers and sellers, and often physically exchanging cash for share registry extracts. In some cases, agents went directly to company towns to buy shares from workers who had received them during privatization and were desperate for cash, selling for fractions of intrinsic value. The biggest risk was custody. Share registries were often physical ledgers held at company headquarters or by third-party registrars that could be bribed. There were real stories of names being erased or registrars disappearing. One company stood apart: Lukoil. Under Alec Purov's push for Western legitimacy, it centralized and professionalized its registry faster than peers, and by hiring Bank of New York for its ADR program in 1995-1996, it effectively outsourced trust, giving foreign investors protection local holders lacked. System wouldn't exist until late 1995. Financials followed Soviet accounting focused on production quotas, ignoring economic depreciation, failing to consolidate subsidiaries. Profit was political, not economic. EBITDA, free cash flow, and GAAP simply didn't exist in practice. For Western institutions, the environment was uninvestable under any prudent man standard. For someone steeped in Graham, the absence of structure and information was the opportunity. The market wasn't just inefficient, it barely existed. Prices were set by the desperation of sellers dumping vouchers they didn't value, not by discounted cash flows. Here's the punchline. Even after a sovereign default and a 90% currency collapse, early voucher buyers were still up roughly 10x. The trade worked through disaster because the entry price was that absurd. That is margin of safety as physics. So what's the real lesson? It's not buy emerging markets. It's not Russia was misunderstood. It's this. When humans are forced to sell and price detaches from reality, the investor with patience and arithmetic gets paid. Lilu wasn't predicting a perfect Russia. He wasn't forecasting stability. He was betting on something simpler. Oil is real. Reserves are real. And the market price was temporarily insane. Time is the mechanism that eventually pulls price back toward value. That's the whole game. You don't win by being the smartest person in the room. You win by being rational when the room is irrational, and by paying a price that makes the future forgiving. This is Avi. Like and subscribe. On to the next.